Welcome to Credit Exchange, your podcast where we speak to the biggest newsmakers and news shapers in finance. I'm your host, Lisa Lee. This week, my guest is Chris Wright, CEO of Crescent Capital Group, a global alternative investment firm with more than $50 billion in assets under management. Crescent focuses solely on corporate credit, and Chris is here to discuss some of the biggest issues of the week. Welcome, Chris.
Great, Lisa. Thanks for having me.
Thank you for inviting me to your wonderful LA office. I love the backdrop.
Yeah, it's you can get used to this pretty easily.
Chris, we have a 30-year Treasury yield that's spiked up to the highest level in 2008, and the Treasury Department, Secretary Crescent, has actually intervened to bring it down. What's going on and how worried are you?
Yeah, I think that was quite a surprise this morning with the announcement of the intervention. I think that the bond market, the way I look at it is the Treasury market's not necessarily saying that growth is collapsing, but we are going through a period where we're repricing risk. And I think the markets are recognizing the risks around a longer term inflation. I think it's recognizing the ballooning deficits of governments around the world. And I think it's recognizing the greater uncertainty that now is going to be expected, further into the future. And so, we have not seen credit spreads, widen out dramatically. And the question really has moved from, when will the Fed cut next to is the economy or can the economy support a higher for longer rate environment? And will the economy continue to expand in this higher for longer rate environment? So that to me is the question that we're asking and trying to get our arms around as we look at what's going on in the bond market. Certainly the intervention today, the question of growth is certainly on the top of mind in Washington. And so I think, the secretary is saying, hey, we want to make sure that we're going to support a high growth environment, despite the issues that are out there on a geopolitical basis, inflationary basis, and an uncertainty basis.
There's some people have posited that one of the reasons why maybe the 30-year rate is going up so high is that there's this real demand for capital, AI, artificial intelligence, and the CapEx need is actually the private sector is pulling capital away from the public sector, making it harder for the U.S. government to borrow. Is that something that you think might be going on, or you think we're a little bit off track on that?
No, look, there certainly is a massive demand, and there is some crowding out that is taking place. I think the intervention is going to, basically say we're going to step in and replace that excess demand that is getting moved away from the Treasury markets. And we're going to go through, we are going through a super cycle here of financing. Now, I do think that the private markets are really stepping in. You've seen some recent announcements on how they're really kind of stepping in to help fill that void. But as a result, they also are demanding higher rates. And so now your alternatives are changing, and, the financing of growth in a more uncertain market is getting more expensive. And so I think it's more about risk placement and the question around how investors should be compensated in a higher risk, higher uncertainty environment that we're in.
So you think the intervention today we're taping on Wednesday, solves this issue, or is it a temporary bandage? Because I look at somehow like recently we intervened to support the yen, and that intervention is already dissipated.
Yeah. I think most of the times these are going to be temporary impacts to squelch, a spike. And then the markets will rationalize over time. I would not be surprised, given some of the reasons that I outlined earlier, that we are going to be in a higher long-term rate environment, because it doesn't solve the question around inflation. The intervention does not solve the question around inflation. It doesn't solve the question around the geopolitical uncertainties, what's going on in the Middle East. And so, I think those are going to be longer term issues that don't get solved by intervention, but the markets will work out over time. And like I said, in the short term, in the credit markets, we're not seeing big spikes. That gives me some comfort that, we're not seeing that, and we're not seeing that in our portfolios either. We're certainly seeing the evolution of a credit cycle. but it's not. It's more idiosyncratic than broad-based, and I think the market recognizes that, and that's what we're seeing.
And that's what's interesting to me. We were actually seeing some data showing that inflation might be contained. Is moderating. We've got decent growth. So the market to respond like this, it wasn't this high even in 2023 when inflation was soaring higher. So is it just inflation, or is it something else that are they worried about? Perhaps a systemic crisis or something underlying?
Yeah, I think you look back to the 2023 example that you had. That was quote unquote transitory, right? And so I think the market bought into that to a degree. I don't think we're in the idea anymore that inflation is transitory. And I think we're moving beyond that. And I think that's what you're seeing is the repricing of long-term assets based on a recognition of a higher inflationary rate going forward. So I think there's a distinct difference between what happened in 23 with the spike in inflation, the story around transitory aspect of it, and what we're seeing today, where we have gone into a place and we've become accustomed to a low rate environment for the last 15 years. And we're recognizing we may not go back to that zero rate environment. And so long-term assets need to reprice.
And how does that impact the corporate credit market that you guys invest in? Because you invest in shorter dated, but also longer dated.
Yeah.
And at what point does it change your thinking about the economy, about growth, and then how you price your asset? Because right now, to your point, corporate credit is really tight. We're not really seeing it reflected in corporate credit at all.
Yeah. Look, I think a higher rate environment, a more sustainable high rate, is a double-edged sword for us, right? We got to find this Goldilocks environment where a rate is high enough, and as lenders, we get paid very handsomely for that. But that rate environment can't kill growth. And I think we're seeing with intervention and lots of different protections around there to maintain a sustainable growth environment. As I mentioned earlier, we're not really seeing spreads gap out in the corporate credit market. And so, as we look at the underlying performance, growth in portfolio companies and just the general companies in general, earnings within S&P, they all continue to be, very positive. Now, obviously, you have some idiosyncratic risks, and you're seeing some defaults, and you're seeing defaults move up.
Yes.
And my view is we are in the, in a credit cycle. We will continue to see them move up, but we're going to see them move up more to historical norms, and that's where they're headed right now, is more to historical norms. I'm not necessarily concerned by that. In fact, I'm encouraged by that because we have lived off an environment that is not sustainable for quite some time. It has probably encouraged too much risk. And we are going to see those cases where when too much risk was taken and was not appropriately priced, those managers are going to be injured as a result of that, or those investments are going to, result in losses. And so it's going to come back to manager selection, sticking with a process, relying on your experience in investing. And I think, as I look at what we've done around here, we've established processes across 30 years of credit investing. Those processes have proven resilient across multiple cycles. And in the low rate environment that we're coming out of, I'd like to think that we didn't get caught up in those. And I think our portfolio is showing that. And I think, the good managers are going to survive and prosper in an environment where we go back to a rising default environment. And I think then capital will flow in that direction.
So it's almost as though we went into a new normal. We're maybe going back to the old way of things where capital costs money.
Yes. You have to appropriately price risk.
Yes. But at what point, when the 30-year is so high, at what point does the very nature of Treasury yields being as high as they are, right, well above 5%, start choking up growth in of itself? And what can the Treasury Department do, or what can the Federal Reserve do? Is there much they can do? They can cut rates, but inflation is spiking.
Yeah, look, we can get inflation under control with short-term rates. The markets are speaking and telling us, okay, we don't believe everything. And like I said earlier, it's not a matter of when the Fed cuts. It's a matter of whether the economy can sustain the inflation. Is there a magical number out there? I don't think there's a magical number out there. Certainly the Fed has a number of tools in place, and capital is going to flow where opportunity is. And so, I think that's what we're going to see. You could certainly see investment dollars. You were talking about, or we were talking about earlier, the crowding out effect. I mean, we're going to see a reallocation, and that crowding out effect will dissipate over time, and money will flow into the right places. So is there a magic number out there? I don't think there's a magic number out there. And like all markets and all cycles, things overshoot and then come back into a more normalized environment. And so I think we're seeing that repricing, and it's going to get normalized, not tomorrow, but it will get normalized over a relatively short period of time.
I think someone like you who invests in a broader way of corporate credit sector and companies has an interesting view on where growth is growing, at least when the corporate that you are investing in. Are you seeing a slowing down of economic growth, of revenue, of margin compression, or is that too early?
Certainly we are seeing, I wouldn't say it's, across the board, but if we went from double-digit revenue growth, that has moved back a bit. And so we are seeing a little bit of a slowdown, nothing that's overly concerning, but I think, as I mentioned earlier, it's indicative of moving through a credit cycle. And so as a result, then you are seeing weaker companies are struggling. And it's not about industry selection as much about business model selection and business selection and management team selection, management teams that are recognizing what they need to do to adapt their business to the new environment, and capital providers working with them.
Well, what about the AI boost that we've all been expecting? Artificial intelligence rising up. Well, for once, the CapEx spending has been fueling economic growth. But on top of that, we're supposed to get some productivity boost from the actual product itself. What do you say about that? And how will that impact? Will this be a little bit of a dip, a slowdown, and then we ride the AI wave? Or has that been a little bit overblown and it's going to take a while for us to see that actually materialize?
Yeah, I mean, I think with some of the expectations that have been set out there, I don't think those expectations could ever be met, right? Because the expectations have been created at such a high level. With that said, I do think we are going to see significant productivity booms. But I also don't think you can take a peanut butter approach and just say everybody is going to benefit or everybody is going to get harmed by AI. And so I think you have to really kind of form a thesis around, where is AI going to help? And some of the help is going to be tremendous. It is going to drive productivity. It's going to allow brick and mortar companies the ability to market better, to, fundamentally reduce their costs of everyday operations with routine tasks, and allow people to be more proactive and identify opportunities much quicker and act upon them much quicker. And so we are trying to look at, where is it going to be highly productive and drive efficiencies and drive productivity. And I think that's there. I don't think we're quite there yet. I know we're trying to implement it. We're spending a lot of money internally in driving that productivity, but we're not quite at the tipping point of really having a super high ROI. There are areas where we're getting positive ROIs, but by and large, we're still a negative ROI on some of that investment. But you have to make that investment because this is a learning process, and AI is going to continue to learn. And if you don't make that investment now, you're going to fall further and further behind.
But what about some of the CapEx spending? Because that has become just not the CapEx spending itself, but all the ancillary second order derivative spending has actually boosted up growth. And we're seeing a lot more growth in the US than, say, Europe, which doesn't share in some of the data center spending.
Yeah.
Do you think that might slow down? Because even today, you see a new financing headline, someone releasing a press release saying we've lent, these billions of dollars.
Yeah.
But at the same time, we're starting to hear about, communities pushing back and saying we don't want data centers built here. How much is there room to run with this CapEx spend?
Yeah.
And how much can we expect that to drive growth?
Yeah. I mean, I think it's an interesting question, right? Because AI certainly has political, societal, economic implications. And we're starting to see the compilation of those different issues percolate to the top. At the same time, I think one of the big themes that we're trying to understand is the circular nature of the funding and how sensitive it is to that demand curve. And it works very well when the demand curve continues to increase. And that velocity of that circular financing is going to benefit a lot. And I think we're still at the beginning stages of that demand curve. But when the demand does have a blip, then circularity can become problematic. And so what I'm hoping is that, some of the political and social and so forth, they need to be taken into account, right? We need to listen to the constituents of this ecosystem that is out there forming. For us, we don't necessarily invest directly. We have another group that does the infrastructure in real estate investing. But we are certainly looking at service companies that are providing services to this growth dynamic. And that has been a big theme of ours, is identifying where those opportunities are, because, I think the super cycle of investing and demand is going to continue for the foreseeable future. But like anything, it's going to get overbuilt at some point.
And so I'm going to move on to another big headline news.
Sure.
Just of a firm near you, just a few miles down, Guggenheim, Mark Walters. I know you can't talk specifically about this, but there's questions raised. The DOJ is probing interconnected loans, insurance, and their investments. There's so much tie-in nowadays with insurance firms, and especially private credit, corporate credit. You yourself, Crescent, was purchased, the deal finalized with SunLife this year.
Yep.
Can you just explain to me, what is this link between insurance and corporate credit?
Yeah. So yeah, absolutely. We were bought by SunLife. It was a two-step transaction. The first step was acquiring 51% of Crescent in the beginning of 21, and then they a call on the remaining part, which closed first quarter of this year. And so now we are insurance company owned. I think the way, look, there's lots of different models out there.
Yes.
Our agreement with them and how our structure works is that we continue to operate very independently as an asset management arm. And so while we invest from their balance sheet, still 90+% of our capital comes from third parties. And so we continue to operate as an asset management. And now we have a $300 billion asset management platform, which includes credit, real estate, infrastructure, and distribution. And so that's how our model's set up. I think there are there's two ends of the spectrum, right? Yeah. There's our model where insurance owns asset management. Then there's the other end of the spectrum
that owns the insurance, which is sort of what Guggenheim, Eldridge, and others
have embraced. Yes. Yeah. And there's lots of rooms in between. Certainly there's been a lot of scrutiny, recently around that interconnectivity that you mentioned.
And then the idea of packaging, especially corporate credit, sub-investment corporate credit, you repackage it, it becomes investment grade and more palatable for the insurance firm.
Yep.
And then to package so much of this, there's a number of firms who've grown a lot of AUM doing this kind of deal.
Yeah. I think what's forgotten, when Crescent was started, and I've been here for 25 years, and I came in and I worked in our mezzanine business. What's not written about is the fact that, who was our biggest competitor back in the day, back in 2000 for doing mezzanine loans? It was insurance companies. And they were a competitor in some ways because they were competing for the same types of loans that we were doing. Maybe they were doing it internally. They were also an investor in ours. They were also co-investors with ours. So that relationship has existed for a long time. I think across the many cycles, business cycles, credit cycles, that we've seen over the past 25, 30 years, that relationship has stayed strong. And why has that stayed strong? It's because the assets that we're able to put on the books match up well with the liabilities that the insurance companies have underwritten. And so that concept is staying strong. Over that 30 years, obviously, structures have changed. Growth profiles have changed. Regulatory scrutiny has changed. Education and intelligence around that relationship has changed. And we're seeing that evolution taking place. Certainly, you're going to see anomalies. You're going to see things that don't either sit well or run afoul of rules and regulations throughout time. I'm not suggesting that's the case at all, because I don't know. But I do believe that private credit continues to provide a very attractive security and asset for insurance companies, and will allow insurance companies to provide their services to their underlying clients. And I think we're going to continue to see that. Yes, we're going to have increased regulatory scrutiny. We got to make sure we're all Boy Scouts and Girl Scouts and executing and staying within lines. And I think as an overall, the industry does that. And whenever you have a light shined on you, you're gonna prove that positive relationship exists. And I think that's ultimately what we're going to see here. I'm very comfortable with our relationship, and I know many of my peers are super comfortable with that too. So I think we're going to continue to see that relationship continue to get stronger.
Do you think there's a difference? Because we just talked about how you are owned by an insurance firm, others own an insurance firm. Do you think there's a difference in how there's a material difference in how you conduct yourself and the way the company is structured between those? Or do you think that's immaterial? It's just a link?
Well, certainly the structures are different. I have never worked inside an asset management, a firm where an asset manager owns the insurance. So I can't necessarily comment on how they conduct themselves and how they operate. I mean, certainly I think about us and how we operate our business as an independent asset manager. And, I have a call every week with our CIO, and just had a call this morning with our CIO to talk the markets, to talk about what we're doing, to talk about some of the challenges of the market, the opportunities. And so just like I have calls with other CIOs of insurance companies. So that relationship is the same, whether it's the owner of us or if it's an investor of another insurance company. And that's how we operate.
And I think also whenever something like this happens, the question that just gets fanned is it a systemic crisis? Because one of the reasons why private credit rose as it did was because regulators said, get it out of the banking system, which it has.
Yep.
But during the financial crisis, one of the reasons what AIG was bailed out, insurance can be a focus of financial crisis.
Yep.
And is the link between insurance and private credit, is that sort of how private credit or asset managers might sort of destabilize the system?
Yeah. Well, I think you have to go and ask yourself, is the asset class stable, right? Is private credit stable? And you ask yourself, is the way in which we deliver capital to companies, is that more efficient than the way that banks do it through the syndicated markets? I would argue that having the ability to meet with management team, go through data rooms, doing the due diligence that we do, working in our case with private equity sponsors, it gives us an information advantage relative to what you see in the syndicated markets. And there are a lot of great managers out there, and I think those great managers take that same approach. And so, I get comfort that, the private credit asset class in general is stable. Now, where do things go wrong? Things go wrong with structure. Too much leverage in the system, mismatch of liquidity, and we're seeing reconciliations and recognitions of some of those mismatches. Those mismatches will get fixed. But by and large, there's increased scrutiny on banks for the leverage that they provide us. That is very much under control. We don't go, there's a lot of scrutiny around the leverage that we use. Obviously, there's been a lot talked about around liquidity mismatch in the wealth channel in particular, but with some structures, interval funds or non-traded BDCs and the like. That is getting worked through and is not creating a crisis of sorts. The insurance company, are they using excess leverage? That is highly regulated, and so I don't see the use of excess leverage
the way the banks are
get their funding
levered
sources.
Vehicles by nature, right?
Yes, and so I get comfort, and I go back to just what is the stability of the asset class, and I think the asset class. Look, like I said, we're coming off of a zero rate environment for the last 15 years. We're going to go back to a normal default cycle.
And defaults will get higher, but not to the point that will destabilize the system.
That's right.
So you've been really kind talking to me about the general market
Sure.
and treasuries and insurance firms. But let's talk about Crescent.
Crescent, perfect.
Because you guys did a $3 billion continuation vehicle
Yeah.
deal. That's one of the biggest that the market has ever seen, not
Yeah.
just what you've ever seen. Explain to me what is a continuation vehicle to our audience, also why you did it,
Sure.
and do you expect to see more of these kind of deals? Because
Sure.
it is sort of a liquidity vehicle, right?
Yeah, the way I look at it, I mentioned earlier sort of a mismatch of liquidity. I mentioned the context of the wealth channel, but I think as we've seen the private credit asset class grow, one of the things that will help in the future and is helping today is liquidity within that, within the asset class. Not because there's a mismatch. We had the fund that we did a continuation vehicle on was a 2016 vintage fund. And the way that those funds were structured back then was they were 10-year funds. Now you have a couple years of that you can add on to it. But the deal that you have is we're going to invest for the first 5 years and then we will continue to harvest it over the next 5 years. So you should think about this as a 10 to 13 year sort of hold period. Given the change in the environment, we had a very solid portfolio because the characterization of how we invest has changed over time, where we are becoming much more important to growth prospects for companies. And so we're doing add-ons. Our money is in the ground a lot longer. And so as a result, at about the 10-year mark, we still had a very viable portfolio. And so what do? We have a couple choices because we have reached that 10-year mark or close to it. And we went to the investors and said, look, you can stay in the vehicle you want. You can sell into this new vehicle, or you can roll your proceeds into this new vehicle. This new vehicle is going to have a new set of investors that understand and have done diligence on the portfolio, priced it very attractively, and then they're going to add a few years to the duration of that so that you can manage those investments. And so the approach that we took was very, very well received. We had a number of very interested parties in backing our continuation vehicle. And we were able to get that done at the beginning of this year. And as you mentioned, I think it still is the largest one that has been done in the space. And so we've been very happy with that. Our investors have been very happy with that. I think it was a great outcome for everyone involved. But the more macro perspective that I started with was it allowed us to give our investors liquidity if they wanted it, allowed them to stay invested if they wanted it, and gave them two options in staying in on what they wanted, the old fund or the new fund.
Now, is this a lot of it driven by the fact that private equity hasn't been doing the amount of deals that they were used to do because their LBOs haven't really come back and they haven't had the exits that we had expected them to? Investors are still looking for LPs of private equity firms are looking for DPI. Was that the driver or is it something else?
I think it's the change in the complexion and the change in the value add that private credit brings to a buyout or an investment. When I started, and I mentioned earlier, we had a mezz business. And when I started, what we would do is we would make an investment, we would collect our coupon, and it would have a 7 to 10 year state of maturity. But in 3 to 7 years, we would get refinanced out or the company would get sold. And we never made more investments, and we got our money back, we returned it to investors, and we moved on. The market for private credit has changed. Now we are a much more important part of the growth prospect. So we're partnering with the sponsors. We're partnering with the management teams. As they look to grow their business, we're continuously investing. And so that naturally keeps us invested longer and allows us to double down on our best performing investments. And so I think you're going to continue to see it. A part of it is, look, duration for private equity sponsors has extended out
much longer.
But quite honestly, if I got a great performing investment with sponsor A and they want to sell it to sponsor B, I'm going to do my darndest to stay in that investment. And this value of incumbency, and large platforms like ourselves, you hear a lot of us talk about the value of incumbency, the value of staying invested. Investors come to us because they want an income stream. The only way to get the income stream is to have that money invested. And so it's part of a little bit of the slowdown is going to increase duration of our investments. But I think more importantly, we have just become a more important part of the ecosystem of financing. And so we're going to stay invested longer with companies.
And another landmark for you guys, Crescent, is that you raised a $10 billion direct lending fund for lower middle market companies. That's a nice bit of firepower you have to deploy now. What is the fundraising environment like? And you guys are directly lower middle market. Explain what that is and how is that strategy being received? Because the big headlines were the $1 billion large cap direct lending deals. And even now the IG mega multiple billions of dollar data center deals. And here, these are smaller deals. There's a lot of them.
So to your question, the fundraising environment, and the fundraising environment is there if you can demonstrate differentiation. So there is.
How do you demonstrate that?
So with this, particular fund, we brought on a team back in 2012, and that firm was formed in 2005, and so they had invested in their vehicle through the GFC and had good performance in lower middle market through the GFC. And so then they were looking for a new home, and they wanted to join a broader platform, and so we were the natural platform for them. And we made a concerted effort to understand that value of incumbency that I was talking about in the ecosystem. If we can invest when companies are smaller and have a lower middle market strategy, we kind of define that lower middle market strategy broadly with companies from 10 million to roughly 50 million of EBITDA. So smaller companies that in many cases are getting their first sort of institutional capital in many cases.
So are you their first major lender?
So we're their first major lender. It gives us an opportunity to cement a relationship, and then that can feed the rest of our platform. And we've stayed disciplined around focusing on that marketplace. A lot of the large players, it's meaningless to, right? It's smaller dollars. It's a much more difficult strategy to execute.
And what's going to keep you busy the next couple of years, or even just the rest of this year?
It's look, this is in an evolving market, in a market that has become a lot more polarizing, right? There's nothing that's in the middle anymore. It's one extreme or the other. And our job is really to kind of see through those extremes and identify opportunities, and whether that be opportunities in being creative in the way that we raise capital. And we are getting creative in the ways that we raise capital and creating structures that work for various types of investors. And so we've been very, very successful with that. We also have the day job that we got to major focused on investing capital in a volatile marketplace. And then we got a big portfolio that we're keeping our eyes on. So we're spending a lot of time on our portfolio to make sure we're being very proactive. And like I said, you're going to see idiosyncratic risks that pop up, and you got to be in front of those.
And you think there'll be more volatility coming up? Because
there is going to be more volatility, yes. And I think that accrues to the benefit of good managers.
Great. Thank you so much for being on this show.
Well, thank you very much.
Having you. And you were having me since I'm your guest.
Anytime. Anyone that comes from LA.
All right. Thank you so much. And to our audience, thank you for listening. And do follow us on Apple or Spotify or wherever you get your podcast. And we're on YouTube now, so you can watch us there. This has been Lisa Lee.